You point out, Gabriella, a lot of people waiting for Thursday when we get that inflation data. And between now and then, maybe a little bit of just sideways action, you think?
I think, honestly, the hyper-growth areas of the market are going to stay extremely, extremely jittery, really taking a lot of cues from the moves in real yields. We've seen them shoot up 56 basis points year to date, all in response to inflation forcing central banks' hands into a much faster tightening cycle this cycle compared to post-financial crisis. So I do think all eyes are on that CPI day on Thursday. We should see another strong print. It's not going to settle any sort of debate about when and how fast tightening happens. That should really be much more with the March CPI, which is going to be our first peak at a month that has a much easier comparison base last year, remembering that it was March when inflation started to shift upwards. So if that inflation print is strong, then all bets are off. So I think until then, we stay quite jittery in the hyper-growth areas of the market.
Does it appear to you that the second derivative, that is the rate of change in inflation, is starting to moderate? We saw that in some of the more recent reports as well. Plus, you point out that the comparisons will be easier since it was already happening. So does that mean that what's priced in to the market with what it's thinking about the Fed action, that's in the market already? 5 hikes, whatever it is that we've seen. Most people have read that, know about it. So if inflation were to not worsen, maybe we've already dealt with that psychologically.
So I think it's much more not just about the rate of change at the headline level for inflation or even at the core level. It's much more what's happening with the very sticky elements of inflation. Are they sticky enough to keep central banks on edge in a faster tightening cycle? And that's where it really goes back to looking at especially the rental measures of CPI, which have not decelerated recently. They're extremely strong at multi-decade highs. So it's really watching the sticky elements of inflation. In terms of what's being priced into the market, so good news, bad news. The good news is we've priced in a lot more. Think back at Labor Day, there was 1 rate hike priced in, and now we have over 5 rate hikes priced in for this year alone. But in terms of, is that enough? I don't think so. That's because if we think further out and we look at the terminal rate that's priced in, it's only 1.8%. right now. So it's this expectation that not a lot more rate hikes are coming next year. It's going to be a quick rate hike cycle. Think last time rates actually got to 2.5%. That's what the Fed thinks is a neutral rate. So there are a lot more discussions coming about next year, and that still needs to be priced in addition to actually what's going to happen with the balance sheet wind down, which can continue to affect the longer end of the yield curve. So we still think the direction of travel here for yields is up, and that keeps investors on edge, hyper-focused on valuations.
Shepard Smith here. Thanks for watching CNBC on YouTube.